Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is April 16th, 2025. Welcome, Professor, back from spring break at the University of Virginia.
Glad to be back.
A lot going on, Professor. The yield on the U.S. 10-year is 4.31%. Yield on the U.S. one-month Treasury is 4.30%. Big topic of today, tariffs. The U.S. is putting tariffs on China up to 245%. China has retaliated against the U.S. with tariffs up to 125%. Do tariffs increase the living standards of the citizens of either country?
Tariffs are a bad idea for everyone. They're not good for the country that imposes them. They're not good for the country that is trying to export into a country that has high tariffs.
Who pays the tariffs, Professor?
The tariffs that President Trump has imposed are all paid by Americans. No one in China is going to pay one dime for a tariff that Trump imposes on goods being imported into the country. They're paid at the point of importation by American companies or American importers. So there's an impression, I think, and maybe even in the president's mind, that somehow all these other countries are paying the tariffs, but they're not. It's really just basically like a sales tax. All the goods that are imported under these tariffs are going to be paying a sales tax. And on average, it takes the tariffs that we imposed before the president was elected, which were about 3% on imported goods, to an average of 23%. So just imagine how you would feel if the goods that you purchase had an additional 20% sales tax that you pay. That's what this is.
Last week, when tariffs were imposed, the markets went down, the Dow, the S&P 500, yet the yield on the 10-year went north of 4.5%. In history, does that happen very often, where the markets decline and the yields increase on the 10-year U.S. Treasury?
It's never happened in my lifetime. Normally what happens when you have some kind of financial catastrophe, which that's basically what happened. The decline in the stock market from its 6,100 high was the fastest decline ever recorded from the all-time high. And so it did create financial conditions that were frightening at the time because of the speed of the decline. Always when that happens, I know of no exceptions, people sell stocks and they buy treasuries. And the effect of that is to lower the treasury yields. That's what normally happens. Did not happen this time. In fact, stocks fell and bonds fell also. So what happened was risky assets dropped in price, but so did assets that don't have risk. They dropped in price as well. Treasury bills, for example, have almost no risk. Now, the 10-year and the 30-year, they have some risk, but they dropped in price, which means their rates went up. We almost hit 5% in the 30-year bond, and the high point in the 10-year note was somewhere around 4.6%. Now, to put that in context, before the tariffs were announced, the 10-year traded briefly in the 3.8 area, so that you had an increase of almost 80 basis points in the 10-year yield, almost a full percent. And that's unprecedented. We've never seen that in American history. The other thing we haven't seen is the dollar has been weak all year. It was down about 4% by the time we reached the all-time high in the stock market, but it's now down another 4 or 5%. So the dollar has been weak all year. Usually the dollar strengthens when you have some kind of financial troubles, particularly if it's global, because everybody wants to get in treasuries. And that means you have to buy dollars to buy treasuries. And that's normally what happened, but not this time. The dollar got hit and the treasury market got hit.
Professor, are you seeing any international aversion to U.S. assets?
Yes, there's not much question about that. A lot of funds were over-allocated to the United States, stock funds, because the United States has outperformed every other market in the world over the last, really since 2009. So over the last 15 years, the best performing stock market has been in the U.S. by quite a bit. And so people had over-allocated. Even if they didn't buy more U.S., just their U.S. stocks went up so much that they became a larger percentage of their portfolios. So what we're seeing now is that globally, outside the United States, people are selling American stocks, and they must have been selling U.S. treasuries as well last week. We're not sure what happened last week, but they must have been selling U.S. treasuries.
Japan owns over $1 trillion of our U.S. treasuries. China owns approximately $760 billion of U.S. treasuries. Do you see any incentive for them to begin selling?
There's certainly no incentive for the Japanese to do that. I can't imagine that China would have any interest in selling U.S. treasuries. First of all, if you depress the value of treasuries by your own selling, you still got a lot more that you own. So they'll be hurting themselves by doing that. But they also, I don't get the sense China wants to antagonize the U.S. or really anybody else in the world. So I would be surprised if they do that. It wouldn't fit with China's previous history to embark on trying to extract some kind of revenge for the tariffs. I doubt that they would do that. They're more likely to take action like they took with Boeing, where they canceled a Boeing contract. And that's a little bit different because if the U.S. doesn't want to trade with them, they've got other sources they can go to. But I don't think they would deliberately try to sell their treasuries. There's no evidence they did that. I think more likely what happened is across the world, people were forced to lighten up. That always happens when markets go down. And so they lightened up in what they could sell in the stock market. And they lightened up with what was available in liquid, which is U.S. treasuries. And that's probably what happened. Normally, the flight is into treasuries, not this time. I think we've made a few enemies around the world here. And so they're less likely to feel that we're the safe haven, that we're the place they want to invest their last dollar. Now, my guess is at some point the president will realize this, especially if these markets continue to perform badly, which they're still doing. And when he sees that, the president is nothing but a survivor. He will definitely try to survive in every way he can, and he'll reverse course. But if he doesn't, and we continue down the tariff path, there won't be any waiting around until it all works. Next year's congressional elections will speak, I think, loud and clear, and the president's party will be in deep political trouble over this, because this has a terrible effect on the average consumer. We've had a great advantage from China. The storyline here is really false, I think. If somebody comes up to you and says, hey, Mr. American, you're trying to produce some particular good, and I can provide inputs to your production at half what you're currently paying. Does that make you mad? Does that anger you? If all of a sudden you can go into Walmart and Target and find all these goods that are 30% less than what can be produced in this country, we're not going to take advantage of that. There are a lot of things we do they can't do. For example, NVIDIA is an American company that produces chips that no one else in the world can produce. We have all these technology sectors that do things. Are we going to just give all that up so we can get back to manufacturing T-shirts and widgets? I hope not. That plan would be a very foolish plan. We don't want to trade places with the Chinese manufacturing groups. What we want to do is embrace it. Embrace what China can bring us, which is a lot of low-priced products that are very, very good. We use them in our electronics. There's a reason that iPhones are produced in Shenzhen, China. There's no way you can produce them in America at anywhere near that cost. That's good for us. That's not bad for us. The reason that there's been consternation over time is that we lose some industries when we trade. And public policy should recognize that and try to compensate the losers. The textile industry, the furniture industry in the Southeast, potentially the auto industry in Michigan. These industries, the steel industry, which was on its way out long before China got involved, they couldn't compete with the Japanese in the steel market and haven't for many years. But these are areas where we should provide some additional resources, maybe build a plant or two in some of the new areas in these areas, and think about how we can help people who are displaced by this. But to walk away from it, like the Trump administration is doing, is a terrible mistake. This is good for America, not bad for America, that we get these excellent products at a low price from China.
You know, the main reason stated for tariffs is the deficit in a balance of payments. To what degree is a deficit and balance of payments a function of different saving rates in the U.S., China, Japan, and other countries?
That's a simple question, really. Let me just give you an example. America is what we call a consuming nation, which means it saves very little. It consumes 96% of what's produced in America. So what does that mean? That means you have 4% left to increase the capital stock. So 4% investment rate would mean that the economy would not grow really at all. That would almost be impossible to grow. But we actually have a much larger investment rate, and the reason is we import the savings necessary to do that. Other countries save for us.
What's our investment rate?
I think in the neighborhood of 15%, although that might not be the most up-to-date number. But it's much higher than 4%, that's for sure. And we have historically, really since the mid-'60s, imported dramatic amounts of savings. And that importation occurs through the balance of payments deficit. Remember what a balance of payments deficit is. If we buy more goods from you than you buy from us, you end up with a whole bunch of our dollars. So what do you do with it? You don't put it in a drawer. You buy U.S. treasuries, you buy stock, you buy plant and equipment, you invest it, basically, in America. And those savings are what generates prosperity in America. If you could just get rid of all the balance of payments deficit tomorrow, you couldn't fund the national debt, and you'd have no plant and equipment spending to speak of. You'd have 4%, which is that's stagnation level plant and equipment spending.
Do you think the deficit and balance of payments over the past 20 years has played a role in our significant stock rise over that 20-year period in that the foreign...
Yeah, and that's how Japan and China ended up with $2 trillion worth of treasuries, because they ran big balance of payments deficits. If you want to eliminate the deficit and still be able to grow as a country, you need to take the savings rate from 4% to 20%. Do that, and you won't have a problem, and your balance of payments problems will disappear.
So if we change the incentives to increase the U.S. savings rate, we could get the deficit and balance of payments to zero.
You could just mandate it. You just abolish Social Security and put in a 10% rate of savings that people can't touch. They'd put it in the market or something. And people would end up with millions and millions of dollars when they're 65 years old instead of collecting $1,500 a month like current system.
Can you speak to the economic effect of changes on the margin? Specifically, people, U.S. citizens are talking about our deficit of $36 trillion. If Japan sells $1 trillion or if China sells $760 billion of treasuries, that's not a significant portion of $36 trillion. But aren't most economic decisions and dramatic effects felt on the margin? So what would be the marginal effect if China decides tomorrow to sell all of their treasuries?
Last week we had a 10-year auction, and there were $40 billion worth of 10-years auctioned on Wednesday. Just imagine that Japan and China decided that day to sell another $40 billion. But I don't see that as a great fear. I do not think China and Japan have it in for us. I don't think they would use their treasury holdings as a weapon. I think the real problem is us, not them. The real problem is we've seemed to have embarked on probably the most catastrophic, foolish economic policy in American history. That's what this tariff policy is. There's nothing even close to it ever in our history that has been as ridiculous and poorly executed. It's poorly executed, but that's probably a good thing. If it was really executed well, we probably wouldn't be trading with anybody. So that's why the stock market rallies once in a while. Every time the administration says, oh, we're going to exempt some countries or we're going to do something like that, the stock market pops right back because it's hoping and praying that this stuff comes to an end. But so far it has not.
Your friend, former associate, Bridgewater Ray Dalio said, quote, "I'm worried about something worse than a recession." End of quote. He goes on to say that the fallout from the turmoil in bonds could be a more severe shock to the monetary system than the 2008 financial crisis. Would you agree with that?
It could be the reason Ray thinks that way. Ray and I worked together at Smith Barney back when I first went to Wall Street many, many years ago. And I think the reason he feels like that, suppose there had never been a tariff policy change by the Trump administration. Suppose nothing had happened on that front. This economy had already shown signs of weakening and stress, and there's an enormous amount of stress in the economy already, and you can see it in the private equity market. No one's been able to exit a private equity investment for the last 4 years, basically. These investments are all sitting right now inside of these funds. Now, what happened just in the last week or two is that the so-called credit spread, in other words, what normal borrowers have to pay in interest, widened out by 200 basis points. Now, let me just do some arithmetic for you. 5 years ago, if you made a private equity investment, you were a private equity firm, you typically would leverage those. So you would borrow in the neighborhood of about 3%, sometimes less. Now you borrow at treasuries plus was 100 3 months ago. That would be about 5.5% if you stacked it all together. It's now about 8%. It's gone from 5.5% financing to 8%. So if you have a company and you need to refinance it, you're paying almost double the interest that you had to pay just 3 years ago. And these companies that are held by private equity firms are not big cash cows. And in fact, many of them don't generate any cash. They're all fledgling companies that you're trying to get out in the marketplace. So you have that problem out there. You just have a whole lot of issues, even if tariffs were not on the table. There was weakening consumer demand coming in. The collapse in consumer sentiment occurred before the tariffs were announced. There was almost a record drop in January in consumer sentiment, and that's long before the tariffs ever came into play. So I think what bothers Ray Dalio, and what really actually bothers me as well, is you're putting the tariffs on top of what might be deteriorating economic conditions in the U.S. And so you're getting a double whammy. So when Ray looks at that and when I look at it, we think, this might not be your garden variety recession. And if you're in the process of decoupling globally with the Chinese and with other suppliers like Vietnam and other places, this could get really catastrophic because how the rest of the world fares affects how we fare. This is a global world, whether President Trump likes it or not. And your point about what happens at the margin, you don't need half the GDP to collapse tomorrow. All you need is a drop by 5%, And all of a sudden, that's catastrophic for a lot of people. And the same thing is true of earnings. If you have an apartment building, for example, and 10% of your tenants move out, you may be going from profitability to a loss. It's what happens at the margin, and that's true of the typical company. And that's a real problem. People like Besant and Lutnick have been making statements, oh, well, it's only 5 or 10% of their revenues. Well, for most companies, that's where the profits are coming from. There are some for which that's not the case, but if you're a local restaurateur and all of a sudden 10% of your customers aren't coming anymore, you're going to be closing your doors. You don't need half of them to disappear. Just let 10% of them disappear. So it's pretty serious stuff, and I think the background of some of these folks, including the president, is pretty narrow. Besant is a hedge fund trader. Hedge fund traders know what hedge fund traders know, but they don't know, they're not well trained in economics. One of my friends told me, well, he taught economics at Yale. He taught economic history at Yale. He's not a trained economist. And Lutnick, I don't know what he's trained for. These people, when you listen to them talk about what they want different things. There's no coherent strategy on the tariffs. If you say, oh, is this to get revenue? And one guy says, yes, it's to get revenue. Another guy says, no, it's not to get revenue. We don't want to import anything. We want to build our manufacturing goods here. Well, you're not going to get any revenue if you're not importing anything. So you have multiple different rationales for a policy, and it changes day by day. One day, Besant says, we will never negotiate. Next day, the president says, we're going to negotiate with 70 countries. And one day, they say, we'll never change this. We'll never step down from this. And then later in the afternoon, out comes an X from the president saying, oh, yes, we're not going to do this anymore. Even today, they're discussing eliminating the tariff for Canada and Mexico for car parts coming into the country. Well, somebody must have told them that unless they do that, they will put Detroit out of business, basically. Detroit cannot survive the current tariff regime. So as the president gradually sees companies getting destroyed, I was watching today on TV the former head of Toys R Us announcing that he's not going to have any inventory anymore because so many of our toys are actually made in China. Now, we could change that all around. Now, when you go to Christmas shop, or if you used to spend $400 on your family for Christmas, you get the pleasure of buying the exact same thing for $1,200. That's where we're going with this. And he was discussing that at some length. I know sometimes people want to hear a kind word about a policy, but the president's tariff policy has no redeeming features.
What was the decline in the U.S. stock market from 1929 to 1933, and what role did the Smoot-Hawley Tariff Act of 1930 play in that decline?
Well, I can tell you the size of the decline, but I can't really tell you what caused it. Everyone debates what the real cause of the depression was, but the Smoot-Hawley tariff certainly didn't help. But by the way, they're not as high as the ones the president first announced. Smoot-Hawley looks like a piker compared to what came through. But I can tell you the details. Everybody thinks 1929 was the bad year. The stock market actually hit its all-time high in February of 1929, hit 420 in February of 1929. Then it had a couple of tough days where it dropped 20%, got all the way down to 320 in October, but rallied back and ended the year about 350. So 420 to 350, that's 1929. By the time we got to the summer of 1932, it was 40. It dropped 90% over 4 years. And just about the time it hit 40, Herbert Hoover was being selected again to run for president. It's not kind of a gloomy situation when the stock market's dropped 90% from the day you were inaugurated, and he didn't do too well in the election, as most everyone knows. I don't think we're going to drop 90%, but look at 2008-9. How'd that work out? It went in the fall of 2007, the market traded at 12,000, and 16 months later, it traded at 6,000. That's down 50%. Down 50% from where we are now would take us back down to 3,000. And depending on where earnings go, Wall Street was estimating S&P earnings to be in the 280 area. Now those estimates are moving down into the 250, 240, 230. When they hit 200, the average multiple in recent years has been about 18. Multiply 18 times 200. It's 3,600. That's a drop of 40%. And that's kind of where the estimates are going to go. If these tariffs stay, earnings estimates will continue to drop.
And then if the multiple drops, you've really got a problem.
If you go to a 12 multiple or something like that, what's 12 times 200? I don't even want to do the arithmetic. I'm not saying that's going to happen. I didn't mean to paint that gloomy a picture. But if you wonder why Ray Dalio is staying up nights worrying about the world, anything's possible. We don't know what the president's going to do. And if he doesn't get off this horse quickly, he will not be able to reverse the damage that he's doing.
Professor, volatile times, time for a podcast next week. Thank you, Professor.
Thank you, Hunter.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.